Anyway, today we are talking about bridge to let. I've been asked about bridge to let a lot recently, both on Facebook and at events and on various other social media platforms. People don't know what bridge to let actually is. In the most simplest of terms, it is kind of what it says on the tin. It's one product that covers the bridging and the buy-to-let aspect of a transaction. For those of you that are relatively new to this, a great way of building your portfolio of buy-to-let properties is to purchase low with buy a property that needs work using a bridging loan, do the work, and then refinance, get a buy-to-let mortgage to pay off the bridge based on the upward value of the property, the new value, what you've been able to raise it to by doing some work to it. And in doing so, you're able to pull out a lot of the money that you put in, so that you can actually go and repeat the process. Because traditionally, you'd go and you'd save up 25% as a deposit. You'd then buy a buy-to-let property, and then you'd be back to square one. You've got to wait and save up another one, so it can take you, decades to build a relatively large portfolio. So that's what we're trying to get away from, is to try and build them quicker, get that cash flow going a lot quicker. And this new product, this bridge to let, that's sort of been talked about, is a way of trying to pull all of that together in one nice neat bundle. So the way to describe it basically is that the whole thing is underwritten at source. Now, usually when we're buying with a bridge, the bridge is quite a quick way of acquiring the property. You still got your searches that you need to do, and there's still some underwriting and all that kind of stuff. But the legals, the underwriting, the valuations are all kind of done at the same time, and lenders are quite geared up to be able to do this kind of finance pretty quickly. So it is quite a quick process. Now, when we go down the bridge to let route, I'm not going to tell you that it's really slow, but it is certainly going to be slower than your average bridge in my experience, because we're actually underwriting the bridge aspect, but then we're also underwriting the buy-to-let aspect at the same time. We kill two birds with one stone. That is good on the back end because it means that process is quicker, but we're losing that time a little bit at the beginning. So what the lender will be doing is they'll be looking at the current value. They will be looking at you as an individual and your experience, making sure you fit their buy-to-let criteria as well as their bridging criteria. They'll be looking at your the work that you're going to be doing. So they're actually going to take more of an interest in the work. You're going to have to provide a schedule of works and all that sort of stuff. They're probably going to want to know, what builder you're using, and make sure you're not using just Joe Jerry's builders round the corner, whatever it means. I don't know where I came from with the name Joe Jerry. If you are Joe Jerry and you're listening, I apologise. I'm sure your building firm is wonderful. But they'll be wanting a lot more of this information up front. When they're doing a valuation, which they inevitably will do, they'll be looking at the value now, the value post works, and whether that all stacks up, and they'll also be looking at the potential rental income, because the buy-to-let aspect on the other side is going to be dependent on that rental income. So they're going to pull that together and make sure that it works at the beginning throughout the process. Now, when we actually get to the point where we're refinancing, some lenders will still require some paperwork. I'm going through one at the moment where we need to effectively submit a new application, but it's going to be a quicker process. It's more of a, what's the best way of describing it? It's more of a box ticking exercise for them. They need to have some literature on file that's updated, rather than, we are starting a new application from scratch, because they have all of the client's information and details already. And a lot of the stuff like the ID and that kind of stuff, because it's within 6 months, we're not going to have to do that again, which is good. So, but what they will do is, so you purchase the property, then the bridge aspect has been now covered as it would be normally with a normal bridge. You go and you do your work. As soon as that property is ready to go back on the market to be rented, and usually lenders like to actually see that the property is on the market to be rented, they will send a valuer back out again. The valuer will confirm the new value again, because there might have been a few months that have gone past, so they want to just check that the The market has stayed where they thought that it was going to be. Obviously, we're living in a weird times at the moment with the coronavirus, so who knows what can happen in the next few weeks. But they will be looking at what the value of the property is now, and they'll look again at that rental income, because obviously they need to make sure that it all still stacks up absolutely fine. Now, if everything is absolutely fine, then it's a relatively quick process to then get that money back out the door to you, refinance onto the buy-to-let product. Usually that's between 2 and 5 years, and your money's back in your pocket and you're ready to go and repeat the process. So it's a great way of trying to keep everything in house. Now, what I now want to discuss is, who is this useful for? And why? What are the negatives of this? Why is everyone just not doing this? Why are we still going from using one bridging lender and then one buy-to-let provider? So let's start with who this is useful for. This particular product is really useful for those that don't have experience. I've got a client at the moment that we just went through this process with before Christmas. She doesn't own her own main residence. She doesn't own any buy-to-let properties. And she has very little in the way of income. So she wasn't really ticking the boxes with a lot of buy-to-let lenders. And as a lot of you know who follow me, when we're going through this process, I like to underwrite, or I like to research the exit strategy, the buy-to-let mortgage first, because I want to make sure that we can actually exit this loan. So that's what we do first. We work our way backwards then to the bridge. So this particular client, as things stood, I couldn't guarantee her that we were going to be able to find her a mortgage product. So the bridge to let worked great, because what it meant was that we could actually underwrite her at the beginning, and we went with a lender that was comfortable with each of those other aspects. Now, it wasn't cheap. The bridge itself was okay. It was about 0.8%, I think, from memory. But, and this is a big but, the buy-to-let aspect was quite expensive. The buy-to-let aspect, I think, was about 5.4% off the top of my head, which is expensive. There's no getting around it. It's expensive, but I think expense and interest rates are all relative. That was the cheapest option available for her. It won't necessarily be the cheapest option available for everyone, but when you don't have a lot of experience, when you don't have a clear exit strategy and you want to try and tie that up at the beginning, you can do it. We didn't go with a mainstream lender with this. You can go with somebody like Precise, for example. Precise, I think, were the first company to come out and do this, where their interest rates on the back end are still quite good. However, their bridging is very vanilla. Their criteria is very vanilla. You have to really fit a square peg firmly into a square hole with them. So it isn't always an opportunity, a product that's available for everyone, unfortunately. But their pricing is probably the best when it comes to the bridge to let at the moment. So they're the kind of people that it's useful for. Those that don't have or can't guarantee a clear exit strategy right at the very, very beginning. And you do need to take a bit of a hit on that, but it's okay, because once you've got that experience, with every property that you get more experience, you get more lender options. So this is just a way of getting a foot on the ladder and getting a seat at the table, shall we say? So what are the cons, or what are the negatives with this? I've already mentioned them really. So the first one is that the bridge aspect does take a little bit longer. So if you're buying at auction, for example, this probably isn't going to be the best route for you, because when the underwriting takes a little bit of extra time, it's not really time that we can waste. When it comes to auction purchases, I really aim to get the underwriting on a bridge completed within 48 hours, so we can get to legals as quickly as possible. That it probably isn't going to happen with a bridge to let, unfortunately. So speed is something that's holding this type of product back. The second one, the big major one, as I mentioned before, is that the buy to let pricing usually isn't as competitive as the wider market. As I said, Precise are one of those lenders who do have better pricing, but then you've got your Castle Trusts and your Romas and people like that, where the pricing is above 5%, unfortunately. So it is going to be a bit more expensive than what you're used to. However, as I said before, if this is a product that works for you and works for your circumstances, you might just have to take the hit on that interest rate on this one property or the next property potentially, the first couple. And I say this to clients all the time that are starting out their journey. There's a reason. Everyone knows that you can make money in property. It's widespread. Everyone knows that. So why isn't everyone buying property? Because it's not easy. It's not easy to start. When you're buying your first, your second, your third property, there are pain points, and you need to just get through those in order to then branch off and start building a wider portfolio, and things do become easier. Both you understand the process a lot better, that there are more lending options for you. Chances are there are going to be many, many more people in the environment that are going to have a much more greater respect for you. You're going to find more opportunities coming your way, both in terms of investor finance potentially, and for projects. Things become easier the longer that you're in it. It is hard at the beginning, but this kind of project helps those that perhaps only a couple of years ago would find it even harder to get into the world of property. So in a nutshell then, that is Bridge to Let. It's a bridge and a buy to let product rolled into one, underwritten all at source. And it does mean that you can refinance. You've got that already sort of covered. One thing I haven't mentioned yet, which I think is one of the best reasons for using a bridge to let, is that something I've discussed many, many, many times on social media recently, which is this 6-month refinance rule. That will not apply to the bridge to let products. The 6-month rule basically is that most lenders require you to own the property for 6 months before you can refinance it. However, there are lots of lenders that are starting to get into this market of pre-6-month refinances, but a lot of them are valuing at the purchase price, or at the purchase price plus the cost of doing the work, which doesn't help you, because we go back to the beginning of the video and I was talking about pulling money back out. If your new valuation is based on what you bought it for and you've spent money on it, you ain't getting no money back out, basically. So the thing to be careful of there is worrying about what the valuer is going to be doing when they're going out and valuing your property. So there are some lenders that will value at open market value, but doing the bridge to let, you're guaranteeing that they're going to be going out there looking at, with an open mind, the open market value of the property. And I think that is my number one sort of best thing, if you like, about the bridge to let, is it is a way of kind of guaranteeing that at least the valuer that's going out to value the property is actually going to be looking at it as an open market value, rather than the alternative that I've just mentioned of the purchase price, or the purchase price plus the cost of the work. So that basically kind of wraps up bridge to let. It is a new product. It's in its infancy, so I expect over the next couple of years that more lenders will be branching out into it and having some kind of version of it. Precise, as I said, were probably the first to come out and do it. They've actually found this market quite difficult. Their bridge to let application form is something ridiculous, like 40 pages long. It's a very arduous process that they've got, but the benefit is that the costing is very good. So if you fit the mold, that's a way to go. And then you've got the other side, your Romans, your Castle Trusts I've mentioned before, that are doing this kind of thing, that are a little bit more expensive. And I'm hoping that more lenders will come out and kind of bridge that gap, if you like, and have some more hybrid products in the middle, which are maybe a little bit more expensive, precise, but a little bit more flexible, and not quite as expensive as the alternatives, but maybe might not be quite as flexible as those. So if you've got any questions about bridge to let, ask me. If you're watching this on Facebook Live, please comment below and ask me any questions you've got. I'll be happy to answer them. If you're listening to this on the Game of Loans podcast, it will be going out on the Game of Loans podcast as well. You can find me on Instagram, Twitter, Facebook, YouTube, LinkedIn, TikTok, and all of the links to my profiles are in the show notes, so you can check me out there. Please send me a direct message, and of course you may well be watching this on YouTube as well. This will be going on to my YouTube channel, so make sure you comment below with any questions that you have. Hope you're safe wherever you are. If you are self-isolating, enjoy as best you can the time out of the office. Obviously I know from experience that I work from home quite a lot, and it can be quite a useful experience sometimes to be out of that office environment and have some clarity of thought. So make the most of it, stay safe, and I will catch you on the next video. Cheers.